SoFi reported arguably the most impressive earnings of any company so far this earnings season, with some tremendous beats on their earnings report. Absolutely phenomenal. I want to go ahead and react to three interviews with Anthony Noto from today. This one's from about 12 hours ago or so. SoFi CEO on Q3, the strongest quarter since I joined in 2018. Looking forward to reacting to that one. He also went on Bloomberg today, spoke about the company very in depth and what's going on with the business model, stock, all those sorts of things. In this video here, I want to address that. And then I want to react to this one from 6 hours ago, Fox Business. SoFi CEO says the company's focused on diversifying the business. 2024, speaking in depth here with Fox Business. So yeah, he went on CNBC, Bloomberg, and Fox Business today. So looking forward to reacting to all this. This is just a dedicated SoFi video. So if you're a SoFi shareholder, you care about SoFi, you're definitely going to enjoy this one here today, folks. I also, just so you know, on the main channel, Financial Education, I did a very in-depth video on SoFi here today, SoFi and PayPal right there. Okay, so I hope you guys enjoy that. Appreciate everybody joining me, by the way. Thank you, everybody. Smash that thumbs up button. Thank you, everybody. Subscribe to the channel. Additionally, just so you guys are aware, we're only about, 48 hours, if not less than 48 hours away from the 30% price increase to the Patreon tiers. So you can see what stocks I'm buying and selling each week. Including today, I actually posted, I sold out of 2 positions with great profits today, and then put all that money into a brand new stock in that Patreon portfolio here today. So if you want to see the stocks I'm buying and selling each week in that Patreon portfolio, then you can click the pinned comment down there, get in before the 30% price increase, which is happening on November 1st. November 1st, price goes up 30% on both these tiers if you're not already grandfathered in. So if you're interested, that is pinned comment down there. Let's get into this.
CEO Anthony Noto. Anthony, great to have you. We mentioned the price action, although we should also point out stock's been on a bit of a tear lately.
Yes.
Can you talk about what the quarter brought?
Sure. Thank you, Carl, and thanks for having me on. This was the strongest quarter.
Yeah, you know, everybody got tied up in, well, the stock didn't go up today. Who cares? The stock's going to be going up a lot. So the stock had ran huge into the earnings. The stock's going to likely run a lot from here. So the fact that it didn't go up today on the earnings day, who cares? And like, maybe the people care that are playing short-term call options on this, it's irrelevant. Like, all that matters is the numbers are great. The stock's going to be going up a lot.
Company's history since I joined in 2018. We saw an acceleration in our revenue growth to 30% year-over-year growth. Importantly, we're not just a lender anymore. We saw 64% year-over-year growth in our financial services and technology platform revenue. Those are high margin revenue streams, high ROE and capital light. And so we continue to diversify the business. We've been able to overcome a really tumultuous environment over the last 5 years, both in terms of rates, in terms of the pandemic, in terms of student loan refinancing, to deliver 17 quarters of record revenue. And this made it number 17. In addition to that, really strong profitability. And so the breadth of the business is driving durability of growth, and we're improving shareholder returns. At the same time, meeting the needs of more members. Our members and products grew 35% year over year. We're really excited about 2025. It will mark I think the best environment we've operated in since I joined 7 years ago, with rates declining and a stable economy.
Yeah, we're hoping on the rate decline part. A couple days ago, the news was about this loan platform agreement with Fortress. Can you talk about what that'll contribute to 25?
Yes, the loan platform business is something that we started back in 2019. Initially, we would generate demand for loans that we would otherwise decline, and we pass those on to partners, and they would provide a loan, and we would get paid a referral fee. And then the next phase of that business was we integrated someone's credit model into our decision engine, and when we couldn't approve a loan, we ran that application through their decision engine, and we got paid a fee for that as well. Now we're actually getting contracts with partners that want us to produce loans on their behalf. The loans we wouldn't otherwise produce, and we get paid a fee for that as well. And so this was a big quarter from that contribution item. Again, it's high ROE, high margin, and low capital intensity.
The important thing to understand why this matters so significantly to SoFi, right, is I think people are starting to get this, and I think Wall Street specifically is starting to understand this, that when it comes to SoFi, this is not just an online bank. Right? Because a lot of people could just look at this and be like, isn't it just an online bank? No. This is way more than it does have absolutely banking components, right? And they can do some business that is absolutely just feels like traditional banking. It's just in a new age way of smartphone first, digital first, rather than physical locations like old school banks, right? But the abilities on the tech side, right, are incredible this company has. And they're very focused on doing asset light strategies, which means they can make fees, right? And they're not as focused as taking on the risk of this particular loan. Why not go ahead, have somebody else take the risk of that? We'll just be the middleman to go ahead and facilitate that, right? And we'll make a fee off this, but then not have to take the risk if that loan goes bad, right? It's not repaid, something like that, which is awesome.
An increasingly a lot of demand for that product. We declined about 80% of the applicants for personal loans at SoFi. And so we have a lot of resources that we could generally monetize. And this is a way for us to do that. So it's a low capital, high margin, high ROE way to do so. And it doesn't really come at an additional cost because there are people we'd be turning down otherwise, or volume we wouldn't have otherwise underwritten because it was above our risk tolerance or where we want our balance sheet to be.
Exactly. SoFi, he says they turn down 80% of people that basically try to get a personal loan to SoFi, right? Well, SoFi might turn down 80%, but of that 80%, there might be 20% of it that some other person would be like, or some other company, some other financial institution would be like, we would gladly give to this person at this sort of interest rate, right? And there's going to be other people that say, you know what, I would give that person a loan, right? And so for SoFi can kind of funnel that out there. Okay, you want that? We'll make our fee here, being kind of the middleman and helping facilitate this thing, right? So I love it. I love it, man. I love anything that SoFi can be asset light, straight profit. I mean, when you're talking about being a middleman, you're making those fees. It's straight profit, man. It's straight profit. And without having to take the risk of the loans.
Low capital is really the hallmark, the foundation for the transition. You've talked about 2024 being a transitional year and 2025 being the year in which you got the wind at your back, so to speak, with a lot of things going right for the business. When it comes to the nuances of the 2024 guidance raised, though, Anthony, a lot of that was driven by lending, which is not the low capital part of the business. And technology, that guidance on the platform came down for a second consecutive quarter. Can you talk to us about where you see that trajectory going as you go into that 2025 year that so many people had so much, expectations for?
Sure. So the lending business grew 14% year over year in the quarter, which was a little bit above expectations. The thing that outperformed was the loan platform business, which is in our financial services sector. We also saw an acceleration in growth in the technology platform. So if you combine the technology platform revenue with the financial services segment platform revenue, that totaled about $238 million in the financial services piece and over $100 million on the technology piece. Combined, that grew 64% year over year, which is what drove the acceleration of 30% because lending only grew 14%. We've increased our outlook for the year because of strength across the entire business. We lowered the bottom ends of the tech platform revenue range primarily because our partners and potential partners have been slow to make decisions given the uncertainty with the election, the uncertainty with the economy next year, and they're delaying decisions. And we just wanted to be somewhat more cautious in that area. We're very encouraged about the demand that we see for new technology services. It's just taking longer for those deals to be decided. It's not that we're losing the deals, it's just they're not been decided, and we think we'll win our fair share. The other thing I'd say is that we're seeing really strong demand in consumer deposits, which gives us confidence on the growth of our SoFi Money business. And our SoFi Invest business is also seeing really strong trends. That's what's driving the 37% year-over-year growth in our products, which we added more than 1 million new products in the quarter.
Million new products in the quarter. Incredible. So, yeah, that was a great interview there by CNBC. I honestly think this one's even better, and the Fox Business one might be even better in terms of really getting in depth here.
Anthony, the story in the quarter gone, it's kind of the result of the work you've put into SoFi doing more. Just explain that a little and where you're bearing fruit in sort of diversifying business lines right now.
Sure. First, to your point about the stock was up about 40% in the last month. So it came into the quarter after a very big increase in value over the last 30 days. So
I love that. Get the elephant out of the room because, these guys, they always bring up the stock price. Well, the stock's moving down, right? Because it had a bad day and it went down. The stock had been tearing it up. It's going to be tearing it up like this little short term, blah, blah, blah. Who cares?
I think we're seeing some of that being taken off the table. But we had our best quarter as a public company. We had record revenue. The growth rate of the revenue accelerated to 30% year over year. That growth was driven by 60.
Yeah, this wasn't just the best quarter. This was by a mile the best quarter, in my personal opinion, that SoFi's ever had in their company's history as a public company, right? Which is incredible because you think this stock used to be a $20+ stock. It's $10 here today, right? We're heading back to 20 plus on this one.
% year-over-year growth in our financial services and our technology platform revenue taken as one. That now accounts for 49% of our total revenue. And so we're not just a lender anymore is the key message. And this is a historic day for us. Not only is it historic revenue, but we're to that 50-50 split between lending and non-lending that we wanted to drive to really continue to diversify our revenue. We've been able to overcome a really tumultuous environment over the last 5 years to deliver 17 quarters of record revenue growth and improving profitability. And we finally got to the point where the business is 50-50, which is right where we wanted to be. The strength is really driven by the financial services products growing 37% year over year, and that's driving the revenue growth that I mentioned.
Part of the sort of slowdown response in the stock, I think, is some investors looking at your comments about balance sheet growth, longer term, low single digit growth. What would be your response to that, please?
We want to grow our revenue 20 to 25% compounded annually. So there's a lot of different drivers to get there. We do not necessarily need to grow our balance sheet at that rate. And in fact, we don't plan to grow our balance sheet at that rate. We've made a migration to more fee-based revenue streams that are capital light and high ROE. This was our first large quarter of generating loan platform business revenue. It's a business we've been in since 2019, but it was a big contributor to both our growth in revenue as well as profitability. So we don't need to grow the balance sheet.
I love this. I love this so much. You know, obviously I'm a big PayPal shareholder, right? It's a significant position for me. We've made a lot of money on that stock, like $50,000, $60,000 already in the public account. I think that's just a small amount compared to the future. But something PayPal does phenomenal is they stay asset light. And PayPal throws off silly money. I think this past quarter, the free cash flow was something ridiculous, like $1.4 billion or something insane like that, right? PayPal's going to have bought back $5 billion+ worth of shares this year. $5 billion plus worth of shares. And guess what? Next year, PayPal's probably going to buy another $3 to $6 billion of shares back. And the year after, they're probably going to buy another 3 to 6 because the company's an absolute ATM. They keep their business very asset light, right? And so SoFi and Anthony Noto really want to try to keep the business as asset light as possible. They're still going to grow their traditional banking side and take risks there and build the balance sheet and those sorts of things. But he's clearly very encouraged by what he sees in the non-traditional, they take the loan risk in regards to his business. And I love that.
Then it has been growing. In fact, we want to take risk off the table and leverage the other pieces of our business that are fee-based. In the quarter, about $175 million of our revenue was from fee-based revenue and growing a meaningful amount year over year.
Let's just talk about pulling that.
As a long-term investor, I love that because we're going to have the big unemployment recession. I don't know if that's a year from now or 2 years from now or 3 years from now or 4 years from now. But in the next few years, we'll get a big unemployment recession where unemployment goes 6, 8, 10, 12%, right? And whenever that day does come, it's a very risky time if you hold a traditional bank, right? Because if all you have is just a massive amount of loans on that balance sheet and then people aren't paying, companies aren't paying, defaults are happening, you got credit losses ballooning, it's rough, right? But if you're a much more well-diversified business and you're not just counting on the traditional banking business, now we're talking. Now we're talking about some true major opportunity to get through that storm out to the other side much stronger than when you went in.
And indeed, a 64% jump in the financial services and the tech platform segments. Where else can you invest there to ensure that 64% is something you continue?
Sure. Within the financial services segment, we have several businesses. We have our SoFi Money business, which is benefiting from a high interest rate. We're seeing great growth in deposits, $2.4 billion of member deposit growth, really strong spending, annualized $10 billion of spending. And so we'll continue to grow that member base at a really high clip. Second is our invest business. It's also growing meaningfully year over year. We also have our credit card business. And of course, our business that provides referrals to other financial services product, which we call Lantern. And then, as I mentioned, the loan platform business. That business itself grew over 100% year over year, and it's annualizing now at $1 billion with really strong improvement in profitability. So we'll keep driving product and member growth in that business in the 30+% range, and that will then follow with revenue growth at or above that level over time.
Talk to us about the macro, because you're saying to investors you feel really good about the current environment, that headwinds have dissipated. Anything that worries you? I mean, we're all still bracing for an election, and that feels like quite a lot of lack of transparency.
Yeah, I do think there's still a degree of uncertainty out there, but I think the trends are clear that we're going into a declining rate environment versus an increasing rate environment. And in a declining rate environment, we have several businesses that will benefit meaningfully. Our home loans business will benefit from more refinancing. Our student loan refinancing business will allow people to refinance their student loans at a lower rate in a lower rate environment. And so those businesses will have a tailwind for sure. In addition to that, as rates come down, the rates that other competitive banks are offering their members or their clients will also come down. And we will be able to maintain a superior rate compared to them because we also own the lending origination platform. So we can use the two of them as a competitive advantage to drive a better APY than our competitors broadly defined. And then lastly, within that business, there's our credit card business. We just launched 2 new credit cards that we think uniquely meet the needs of our members. That have a lot of growth prospects behind them as well.
Anthony, what's your M&A plan from here for things you don't already have?
We're heads down. We're not focused on M&A at all. We're not focused on capital raises. We're focused on growing our business organically.
Exactly. Why would SoFi need to do any M&A right now, right? Merger and acquisition, this just doesn't make sense. Like the company has way too much growth. Like there's pretty much not another financial institution out there that wouldn't trade places with the growth rate SoFi has. And right now is not the time you want to do deals in the banking space. There will be a time to do deals in the banking space and to pick up assets for very cheap. You do know when that is? It's when we have that big unemployment recession. Whenever that comes down the road, that will be the moment that if SoFi wants to go in and do some M&A, you'll be able to pick up assets for a penny on the dollar, for a dime on the dollar, for a quarter on the dollar in that particular situation, right? And so that will be a great time. And by that time, hopefully SoFi is just pouring money in, right, in regards to their quarterly net income, and they can buy out other assets if they want, whether that's other fintech opportunities, whether that's, B2B plays in the financial space, whether that's even banks, right, small regional banks or whatever makes sense, right? Not everything will make sense, but there might be some strategic acquisitions that, maybe SoFi can acquire a big customer base for picking up something that, went under and the FDIC is looking to kind of get rid of, right? So there's a lot of opportunity there, but not right now. You don't want to deal deals right now. Like Anthony Noto says, heads down, we're focused on our business.
25% in revenue on a year-over-year basis, balance sheet growing much slower than that, and continue to build unaided brand awareness. Our unaided brand awareness is a key to become a household brand name. It's a key to become a trusted partner in a business where people have to trust you to give you their money. Yep. And we've driven that up 40% year over year to 7%. Our goal is to get it into the 30% range. We're well on our way and making great progress.
Have you got any worries about the consumer at this point, Anthony, and consumer credit quality?
Sure. Our credit has actually continued to improve. We saw a peak in credit normalization in Q1, and it's gotten better each quarter since then. That said, we're very vigilant in making sure that we think we'll be in a stable economy. Declining rates with a recession would not be great. Okay. Declining rates with a stable economy would be great, and that's what our current forecast has for 25.
Anthony, we literally have 30 seconds. The election, how are you braced for it?
We can work with whatever administration we have. There are different characteristics of the administration that could be more favorable for our business. I would say generally more favorable capital markets would be welcomed. More favorable treatment towards businesses would also be welcomed. There's a lot of opportunity that sometimes gets stifled by different approaches as it relates to capital markets, to M&A from the different agencies. So we're looking for a good balanced approach from whatever administration wins, but we're prepared to work with both ends of the aisle.
Yeah, at the end of the day, SoFi will work regardless of who wins the election, right? Obviously, if you know my opinion, I have an opinion on who's going to win the election. I don't think it's going to be close, but regardless, like SoFi is going to make it, through whoever ends up winning, right? All right, next one up here, this one from Fox Business today.
For SoFi, shares of the fintech have spiked 33% month to date. But the stock is pulling back right now, even after the company posted its strongest quarter in history. The financial services platform reported its fourth straight quarter of profitability on a GAAP basis and raised its full year forecast. With earnings of 5 cents per share and adjusted net revenue of $689 million, both came in above Wall Street estimates. SoFi's success can largely, at least this quarter, be attributed to its lending business, student personal and home loan originations for the bank, all soaring year over year. I mean, home up 38%, personal up 26%. But in the face of the massive growth there, SoFi's CEO said on his earnings call today that they're no longer just a lending company, but a force to be reckoned with. Joining us now on where the force will flex its muscle next is SoFi CEO Anthony Noto. Anthony, your success in lending is solidified. I mean, that's what it feels like, I think. What are the areas you're now pouring investment and resources into to power the force that you talked about on the call?
Sure. As you mentioned, our business was built on the back of lending, but this year, 2024, we endeavored to diversify the business, make it less risky, less capital intensive, higher margin, and higher ROE. So we've really focused on our fee-based businesses that can scale.
ROE, return on equity, in case anybody's curious.
Tremendously. And so in the quarter, we had 64% year-over-year growth driven by the combination of our financial services business and our technology platform business. That business now accounts for 49% of our total revenue compared to 30% a year ago. So we're now evenly distributed between lending and non-lending, and that's why we made the point we're no longer just a lender. And that business, up 64% year over year, is growing meaningfully faster than the lending business, and it's where we'll continue to put significant resources. In those businesses, our SoFi Money, our checking and savings account that gives you high interest at over 40% on your savings account. We have SoFi Brokerage, SoFi ETFs, SoFi Robo. We do IPOs in our invest business. And earlier this year, we launched alternative asset classes, which have done really well. Private credit, private venture capital, and private equity. In addition to that, we have our credit card business and our insurance business. And we're really putting a lot of our resources to drive member and product growth there. Our member growth and product growth has remained above 35%. And that's a leading indicator of our overall revenue growth, which is what you're seeing manifest itself in today's results, with that growth of 64% driving the overall growth of 30%.
I mean, it looks really, really good across the board. It feels like you have had, because you come on the show just about every quarter to follow up and update on the earnings, things have just progressively continued to strengthen. And it just feels like you're one of those people who puts one foot in front of the other, execute. But it is really rare to hear a CEO say they don't see clouds on the horizon. And you told Barron's yesterday, I thought this was really interesting. You said in 2025, you don't see headwinds. That's pretty bold, isn't it? What's really backing that?
It is. We have navigated through a really tumultuous environment every year since I joined in 2018. 2018 rates were going up for the first time in almost a decade. We then hit 2019 and the Fed abruptly stopped raising rates. Then the pandemic hit, which led to a recession and an overnight drop in interest rates by 150 basis points. And the student loan moratorium that lasted 3 years, 2 years longer than it needed to, which really damaged our student loan refinancing business. And then, of course, we faced a 500 basis point rate increase environment over the last 2.5 years. The reason why I said we have wind at our back and why we're looking to 2025 is we're likely going to be in a declining rate environment, which puts wind at our back in a number of our businesses that have not been growing as fast, specifically home loan refinancing and student loan refinancing. But in addition to that, if we have a strong economy, we'll continue to see strong spending in checking and savings and credit card, as well as people looking to invest even more if they can't get a great return on their savings account in a declining rate environment. And then last, a number of companies have really put off the technology upgrades they need in order to meet their regulatory requirements, as well as the incremental risks of fraud and all the AI implications. And so we see a surge in the tech spending as well.
I would imagine. What about that capital expenditure that you have to put into it? I was just at the Money 2020 conference yesterday. A lot of talk about identity fraud. It's unbelievable how electronically and algorithmically the bad actors can just continue to keep tapping on the electronic walls and try and worm their way in.
That's right. And we've launched a couple of really important fraud products in our technology platform. In fact, it's the most popular product that we have interest in. Our ability to do transactional fraud monitoring through AI and all the data that we have with over 160 million accounts enabled through our technology platform is a hugely needed service, and one we're seeing a lot of support behind. We call that Payment Risk Platform, or PRP. And there's another evolution of that coming out called Give. So a real opportunity for us to help the ecosystem overall from all the bad actors.
Yeah, it's really kind of depressing. You're just trying to run a business. Consumer confidence, we already showed it. It came in pretty solid. And when you say no headwinds, I imagine that that's sort of part of it. What are you seeing from your clients where they want to make the biggest impact to try and grow their money through SoFi?
Yeah, so the member base that we have continues to do more and more for us. One of our leading products is a SoFi Money product, which is very differentiated with high interest of over 4%, no fees, free overdraft protection, the ability to send your money person to person with a phone number or an email or with Zelle, in addition to doing bill pay. We make that a great product. Once people use it and they make it their direct deposit checking and savings account, we then see them take on another product and another product, which allows us to get a faster payback, and we can invest more in the business and invest in new technologies and new services. This quarter, we had our first large quarter in our loan platform business, which really started back in 2019. The great thing about this business is that we can actually serve more people on the lending side by being hired to underwrite contractually and be paid fees for third parties that want to underwrite the loans that we're not underwriting or wouldn't otherwise underwrite. And so that's an incremental part of the equation that's helped us this quarter. So we're seeing more demand for buyers of our loans, seeing more demand for technology from our partners, and of course, we're seeing really strong trends in deposit accounts and spending.
You know, I look.
Great interviews. You know, Anthony Noto's really setting up for, you know, Jamie Dimon from JP Morgan likely going to ride off into the sunset in the next 1 to 3 years, right? And then we're going to be looking for who's going to take the throne to be that real, like, big name banker, right? To be out there always talking to CNBC and Bloomberg and at these big conferences and things like that, right? And who's going to grab that throne when Jamie Dimon gives it up here in a few years, right? And maybe Anthony Noto's the one that, you know, everybody starts to look at and want to hear their opinion on the economy and where rates are going, what the Fed's doing, and all these sorts of things, right? Which is a phenomenal position to be in from a branding standpoint for not only him, but for SoFi, right? So I think that's pretty exciting as well. But yeah, I once again, I spoke in depth about SoFi and where I see the stock going and all those sorts of things in this video right here from the main channel earlier today, if you didn't get to see that, okay? Alrighty, guys. Appreciate you joining me as always. Once again, pin comment down there if you're looking to join my Patreon, see the stocks I'm buying and selling, get access to the Market Hours Discord chat in there, 5-Figure Club, all those sorts of things. Those prices are going up 30% on both those big tiers, the 25 tier and the 125 tier. It's going up 30% here in about, 48 hours from now, less than 48 hours. So, yeah, if you want in for the grandfathered prices, it's your last chance. Much love and have a great day.